Another insurance policy in our life? You've got to be kidding. Don't we have enough of those? Stay tuned. Let's talk about this. Let's find out. Hey, everyone. Welcome to another episode of Inside the Deal through Michael's Eyes. It's a fresh take on real estate and business in general. My name is Michael Renick. I am your host for this podcast. In previous podcasts, I've given my background and information. We can go back and do some of that. But I've been in business for a long, long time, both at General Motors before I retired and then now in real estate. Let me bring on a very good buddy of mine. I call him Don B. I'm going to live on the edge. Bartolomucci. Am I even close?
Outstanding.
Ooh, I'm getting good on that thing. So
another 2 years, and we might say it perfectly.
So this is a man I call the mortgage coach. Let me explain why. When my clients need a great mortgage person, Don is the only one that I refer to. Over the years, he's demonstrated the same passion as I have for doing business the right way and getting the job done. As we all know, the mortgage process is a complex one, fraught with all kinds of perils. With an extended partner such as Don, he gets it. His job is to deliver a quality product each and every time. What I like about Don is he doesn't provide excuses. He provides results. Now, we are still challenged a little bit. Don is working on a camera setup. We put a new camera there. Obviously, we've got some more work to do, and we're committed to do that. Most of the folks that come into this podcast are going to hear our voice anyway, so that's not a problem. But this quality thing, we will get it fixed. We're new with this kind of stuff, and we'll make it happen. But Don, welcome. How are you doing today? I know you're frustrated with the camera, but putting that aside, how are you doing?
I'm doing great. I didn't think I was so technologically challenged, but there you go.
You know, when I woke up this morning, one of the things I was thinking is there's just not enough insurance policies in my life. You know, I've got vehicles, I've got condo insurance, we've had a couple of hurricanes, we've gone through those, and my life is surrounded by insurance agents and brokers and stuff like that. And now I find out we may have another one. And they actually call this let me just say mortgage insurance. Don, help me here. What's going on?
Well, first of all, we're going to debunk what the perception is of mortgage insurance. I'm but I'm really not a fan of insurance. However, this particular one does have its value. And we'll explain in detail in a second, but in detail, mortgage insurance is nothing more than a third party, whether that be HUD for FHA, the Veterans Administration for VA, the Rural Housing Development for USDA, or private companies for conventional loans. These are companies that come in and say, borrower, we know you can't put 20% down, or you don't want to put 20% down. We'll come in and guarantee the difference between what you put down and that 20% equity position. So in a nutshell, mortgage insurance is a third-party company guaranteeing the mortgage lender that their risk is reduced to 20% or 25% equity if the loan will go to foreclosure.
So let me ask this. And so mortgage insurance doesn't guarantee the loan in its entirety. If my 20% was 20,000 and I only put 5 down, it's going to guarantee the remaining 15,000 out of the $100,000 loan. Is that correct?
Yes, that's correct. There's a little more detail when you get into the mechanics of it, but that's exactly what it does, just as you explained it.
So what it does, it's going to reduce the loan for the bank or whoever provides the mortgage. It's also going to make the buyer, the candidate, stronger in the bank's eyes because they've now got the insurance to bring it up to that level. I could ask you, and I don't want to put you on the spot, why 20% is the magic number, but we won't go down that rat hole. We got a lot of things to talk about today. So can I say PMI when I talk about mortgage insurance? Is that not the right acronym, or is there?
It is an acronym. but it's specific to a conventional mortgage through a particular company. So PMI is private mortgage insurance.
So it's one type of multiple mortgage insurance.
It's one type of insurance for conventional mortgages. Correct.
So if I'm a buyer and I don't have enough of the down payment, mortgage insurance is not discussable. It has to happen.
That's correct. And he or she is your friend. Mortgage insurance is really your friend because it's allowing anyone to get into a property without having to put all that equity into the property themselves.
So we don't rehearse these, and I love to take these down certain rat holes. So I'm going down this one here. So is the cost of mortgage insurance going to penalize my ratios that I need to approve the loan?
Well, it does affect it for sure because
Okay.
you are paying a premium just like you are on your car insurance or life insurance or any insurance premium that you have. But it's such a small amount that it generally doesn't really affect your ratios that much. Now granted, it does, but it's generally not the determining factor that pushes somebody out of qualifying for a loan.
Oh,
It normally more so puts a person in to qualifying for a loan than not.
so the cost goes into the ratios. That makes sense, just like some of the other things that go into it. So I come to you and I'm a borrower and I don't have the money for the down payment. Do you can we shop different ways to get mortgage insurance? I mean, like I go out and shop my car policies or my condo policy or something like that.
You can with conventional mortgages, yes. With FHA loans, you have to get it through HUD. VA loans, you have to get through the Veterans Administration. USDA loans, you got to get through Rural Housing. So the answer to your question is yes and no, depending on the type of mortgage product that you're using.
You don't think I'm going to ask you an easy question, a simple question, right? Where you can just answer one way. We've known each other for far too long for that. So are the rates different enough? So let's say I'm conventional and I don't have the cash for the full down payment and I need mortgage insurance. Is there that much difference in the rates since we're shopping around, or are they pretty similar?
They're pretty similar. FHA, there's only one game, so it doesn't matter. It's a fixed amount. It doesn't change. It's what it is. What it is.
The conventional. If
By the
I'm
way,
going to go conventional,
just to finish that thought, with USDA loans, it's a certain percentage. It's the same regardless of your credit score, regardless of your ratio, regardless of anything. VA loans, by the way, USDA loans, they call it a guarantee fee. You mentioned the terminology, PMI. With USDA, it's a guarantee fee. With VA, it's called a VA funding fee. The word insurance isn't in it, either of those, right? It's a VA funding fee, but it is insurance.
it's the same thing, correct?
And then on conventional loans, it's MIP, mortgage insurance premium. That one's a little bit more direct. It does say insurance. And then with conventional loans, as you mentioned, it's PMI. So let's go back to answer your question, because I did want to identify the difference in the four types of mortgage insurances that are called different names. And they do that, Mike, so I have a job. They make it really
I wasn't
complicated.
going there, but that's all right. That's we all have our own lingo, right? I, as a real estate broker at General Motors, before I retired, as a IO, information officer, IT. You guys, bless your hearts, you have your own lingo, but it's the same concept. Is that correct?
That's right. Insurance, it basically guarantees that shortfall in equity for down payment, regardless of which product you're looking at. But let's answer your question. Can you shop it around? A conventional loan, you can. There are 5 companies in the United States that I'm aware of right now. There used to be 6, but there's 5 now. And those 5, we shop against all 5 of them, and we negotiate contracts with each of them to try to get a better premium for our clients. And basically what we do is we look at the 5, We choose which one's the best, and doesn't matter who it is because it's doing the same thing. Ensuring
So
the full equity.
do you go out to all 5 every time you get a new buyer, or you do
Every
that
time.
every time?
Every time.
Okay. Do the numbers differ that much?
It could be 0.2% So to answer your question, it's not significant, but 0.2% is 0.2%, and it's transparent to the borrower because it's mortgage insurance. That nobody really says they look forward to paying for mortgage insurance, so why not give them the best price we can get?
So, all right, I'm coming to you. I'm a buyer, and we're going to look at mortgage insurance as a possibility. Let's say, here's my dilemma. I have the cash for the 20% down, but I'd like to use some of that cash on something else. Of course, after I close on the loan, so I don't take on any more debt. But how do I noodle through that process with you?
This is amazing because this is unrehearsed, and I wrote a couple things down here. And if you don't mind, I will pull my glasses just for a second. And if I had my dry erase board behind me, I would draw this up for you. But let's use an example, Mike, because this is where I think we are missing the value. I hate to say insurance, but the value when it comes to insurance, but we are missing the boat because of that feeling that everybody has. I'm throwing money away. So let's use a $300,000 loan, if you don't mind, because that's the numbers that I worked up. On a $300,000 loan,
I like to use another number just to put you on the spot. Of
we
course,
can do that. I have my calculator.
no, it's fine. Go for it.
Now, an FHA loan has more than likely the higher premium cost. So in this example, this is going to be a high estimate. So we have that premise. So
Okay.
the same example is going to stand true for conventional, for
Okay.
VA, or for USDA, but this is a worst case kind of scenario. Okay.
Okay, go for
So
it.
if you have a $300,000 loan, and you want to put 20% down, how much money do you need in cash?
That's 60 grand. And I don't even have that written down.
You see how my numbers work really easy, really easy.
You're not putting me on the spot. Thank you.
So with FHA, you only have to put 3.5% down. So if I'm only putting 3.5% down, my shortfall is $49,500. So you, Mr. Buyer, can put $49,000, $49,500 in your pocket, use it for.
So let's stop for a second though. So the 3.5 is the 3.5 versus the 20. The 20 is 60,000. The 3.5 is 49,000 and some less than 60,000.
That is correct.
Do you have that number written down?
Well, it's the difference between the two, so that would be.
I know it is. Do you have
20? It would be 19. What is it? What was my? I can't do that math.
Not a problem.
So, but keep that number in mind. So I'm just talking about the amount of money that you don't need to go get a gift, that you can leave in the bank, that you can use for buying furniture,
or I don't have to liquidate another cash asset that I may have.
So the cost, so it does cost you. So the cost of that is, in this example, the FHA is $139 a month or $1,650 a year.
Based on the 300,000
numbers on.
Yep, that's on the $300,000 example.
That's on a $300,000 loan. So what I did is I said, okay, it's going to cost me a year $1,650 of money that I really didn't have to pay because I've got 20% down. I just chose not to use it. Make sense?
Yes.
So the first question, and I'm not going to answer this, but how much money will your $49,000 make invested in the market interest, dividends, whatever. Just throw that on
Or
the
that
side.
shiny new car I'd like to buy.
Or a new car you want to buy, or better yet, I got to buy curtains. I got to rekey. I got to buy furniture for the room. I only have two bedrooms and I need 3 bedrooms. There are expenses that you're going to have when you purchase the home.
Correct.
So my contention to the naysayers when it comes to mortgage insurance, you get that Uncle Joe and Aunt Sally said, never pay mortgage insurance. You wait until you get 20% down. Well, my rebuttal to that, Mike, is how long is it going to take you to save $49,000? Let's say you don't
On
have
my
it.
salary as a real estate broker, a very long time. Go ahead.
Now let's do this math. Let's say you bought that house at $300,000,
Mm-hmm.
and in Florida, appreciation is probably a little more than 4, but let's just say we use 3.5% in appreciation per year. Take 3.5 and multiply that by your $300,000.
I bet
And
you've
your
got that
house
written
is going
down.
to appreciate about $10,500 a year. So that's equity that you're building because you bought the house today.
Mhm.
It cost you $1,600. I'm rounding now. It cost you $1,600 to do it, but you gained 10. I don't know. My math says I'm still ahead $8,000 or more. Does that make sense?
It does. So let me throw a curveball at you. The interest on the loan is tax deductible. We're not tax experts, but is the PMI also deductible? If
Why
we
you
don't,
gotta ask me?
if it depends, it depends.
It is. It depends on your tax bracket. It's actually it's going to sunset here shortly. So let's just say it is today, but it may not be tomorrow.
Okay. So let's come back to, so I've signed up for this $1,600 penalty per year, right? And
Call it
on the loan. Now, as I start paying down the loan over the years, is that percent so it ratchets down? In other words, the 20,000 gap, the gap that I even put the 20 grand or 20% down, that gap shrinks over time, right?
That's right.
Ah.
And with conventional loans, that mortgage insurance can be forgiven and go away. There's a couple ways, and there's a federal regulation that everybody has to abide by. And I can quote that to you in a minute. With FHA loans, unfortunately, it never goes away. You have to refinance to get rid of it.
Okay.
VA loans doesn't go away. USDA, the government basically, the government loans, it doesn't go away. Private loans, they do.
But it doesn't go down.
Okay.
It can go away, but it doesn't go down. Is that correct?
All right.
All right. So, is there so let me just throw a curveball at us. Is there a possibility that I could get approved for the loan? I qualify for the loan, but one of the mortgage companies won't provide mortgage insurance. Does that ever happen?
Wow. Mike, that's a really, really, really good question. It is so rare.
Okay.
I could never say never, but I can't think of the last time I couldn't get mortgage insurance after we approved the loan.
Do they, because I'm going to guess, use similar approval processes for mortgage insurance as a loan would?
We all underrate Fannie Mae, Freddie Mac, and they're underwriting to the same guideline as well.
All right, so let's really jump over the cliff now. Not live on the edge, but let's jump over the cliff. Is there a chance you've ever gotten someone approved for mortgage insurance but couldn't get the loan approved?
Yes.
That can happen? Okay.
That would be, again, extremely rare, but it's probably a slight chance of that happening over the MI company not approving it.
Okay, so one of the purposes of these podcasts, one of the main purposes is education. And we've had some fun because I believe having fun, we learn a little bit better, but we're learning about mortgage insurance. What else? Is there anything else that we would like prospective buyers out there or sellers? I mean, is there a benefit for sellers when they're presented a mortgage offer that has PMI or mortgage insurance attached to it?
Yeah, Mike, my goal with this conversation that we're having right now is to remove the stigma. I mean, literally remove the stigma about mortgage insurance, because it really plays an important role. In other countries, you don't have the ability to do what we do in the United States because of mortgage insurance. In other countries, you got to have 50% down, or you got to have a significant down payment. So that is a value, in my opinion. But let's drill down again to your question. What else is there about insurance, that mortgage insurance, that we want people to know? And that really is that, especially sellers. Sometimes I hear, oh, you know what, a 20% down buyer is more perceived, more a little better than a buyer that needs that's only putting 5% down, for example. And I beg to differ. And I beg to differ because, and this is the part, if you remember at the very beginning of our conversation, I hedged on you a little bit with that 20%. The insurance company is guaranteeing us to the 25% equity position. The truth is, the insurance companies actually guarantee us to 25% equity. So, for a seller's perspective, a lender with 20% down, let me rephrase, a mortgage with 20% down and a mortgage with 5% down, from the lender's perspective, guess who is the more risk?
The 20%, because 5% you're up higher, right?
I got more equity. Yeah.
I'm trying to think back in all of our transactions. Does a seller know that there's mortgage insurance involved? They know the down payment percent. That's all part of being transparent.
Yeah, Mike, I would say it's presumed that they know. If you're only putting 5% down, you're getting the other equity someplace.
But that's a tool I can use if I'm representing a buyer and I'm presenting that to a seller. That's a new tool. See, we learn every day. It doesn't matter how many years we've been involved in this thing. That's a tool I can use to show the seller the strength of my buyer's offer.
So I guess to maybe drill this home, if you have a buyer with 25% down and a buyer with 5% down, from a lender's perspective, our risk is the same.
Okay, got it. Anything else that would be important so that both buyers and sellers are a little bit more educated on mortgage insurance?
Probably the one thing that I want to leave you with, I gave you an example of a worst case scenario, pretty much worst case. If you're a 5% buyer and you have a 740 or higher credit score, your mortgage insurance is going to be half of what we were talking about today. Okay. And $1,600, $800 a year to not have to put $49,000 equity into a property. I don't know about you, but I might keep my cash and pay the $800.
Yeah,
so
I'm all in.
You see what I mean? So I just want the public to get it. Insurance is really not that bad. Mortgage insurance.
Got it. Don, thank you for this. This is going to go live in 2025. I'm starting to build the queue up for those. So I want to thank you for everything you're doing to support this podcast effort. Don, there's going to be some people with more questions. So how are they going to reach you? What's your email address and phone number?
The number, the Sarasota number is 941-227-7618. And nobody can say my last name. So my email address.
Ooh, that was a shot. I like that. Go ahead.
My email address is Bart, that's B-A-R-T, first four letters of my last name, and team. So bartandteam@gmail.com.
BARTANDTEAM@gmail.com.
That's right.
All right, Don, I want to say thank you.